All right, now, corporation tax. Today's lecture is on the basics of corporation tax. We'll look at the basics, and next class will be on group taxation. We'll do some kit in the next class, and then we'll finally move towards our losses chapter, where we have to look at corporation and individual losses. In terms of, we've already looked at some losses, for example, property, capital loss, right? But we have to look at trading losses more specifically because the rules for trading losses are more important.
Okay.
Now, the rate of corporation tax in UK is 19% for a company that has taxable total profits. All right. A company that has taxable total profits is situated in UK. That means situated means is UK resident. Situated does not only mean that it's physically present in UK. It means that it's a UK resident company, right? It will pay
Yeah.
19% on its taxable total profits. Now, there's a difference between two things, that is accounting period and period of account. Okay. Accounting period is the period for which HMRC considers your accounting profit to be taxable. All right. And that cannot be more than 12 months. HMRC will never tax your profits for more than 12 months because then a separate accounting period will start. So one accounting period cannot be more than 12 months. All right. Whereas period of account is the period for which a company prepares its financial statements. All right. Period of account is the period for which a company prepares its financial statements. Yes, in the accounting world, we call it accounting period. I understand, right? But in the world of tax, accounting period is the period for which HMRC determines your taxable profit and taxes your profits. And period of account is the period for which a company prepares its financial statements. All right, it can be more or less than 12 months, it depends. Okay. Now, the point is, what if the period of account, because of an accounting period cannot be more than 12 months, right? But what if a period of account is more than 12 months, right? It's called a long period of account, and two accounting periods are derived from one period of account. So, for example, one period of account starts from, let's say, I prepare my accounts from 1st Jan 2020 to 31st March 2021. That's 15 months, correct? This is my period of account. It depends, it is at my discretion as a company as to what period of account to choose, right? Obviously, it cannot be on a repetitive basis. This could be the first period of account or probably the end of the when you're seizing the business, right? But HMRC will derive two accounting periods from this one period of account. One would be a 12-month accounting period, is a whole accounting period, and another will be a short accounting period, which will be for the remaining months. All right. Do you understand? So you
Yeah.
will, your basically taxation will depend on this 12 and 3 months methodology. Now, these are some planning points that I've mentioned over here. Advantages of having a 31st March year end. Why? Because a company pays tax for a financial year, right? A financial year starts, HMRC's financial year starts from 1st April to 31st March. That means for companies, it collects tax for the period 1st April to 31st March. Okay, do you understand? Now,
Yeah.
that's why I mentioned some planning points where you will see advantages of having a 31st March year end. The second most important thing to determine over here is how to identify, and you get questions on this, how to identify whether a company is UK resident company or not. All right. How to identify whether the company is UK resident company or not. The first and foremost important point is incorporation of company. Where is the company incorporated? Is it within the UK or is it overseas? Right? So if let's say it's within UK, if it's within UK, it automatically becomes a UK resident. If it's within UK, it automatically becomes a UK resident. But for example, if it's situated overseas, if it's incorporated overseas, then there are certain additional factors that you have to check, right? So the second most important factor in this case would be, where is it being run from? Where is it being controlled from? Where is it being managed from? Is it being managed from UK? If it's being managed from UK, that means if most of the directors and majority of the shareholders are in UK, that means the company is UK resident. It will be treated as UK resident. If minority shareholders or minority directors are in UK, that means the majority would be situated overseas, right? Majority will be living overseas. In that case, the company will be an overseas company, therefore not UK resident. Okay. The element for residence of a company is more important with respect to ATX, because a UK resident company pays tax on worldwide profits. All right. Worldwide profits. Okay. But again, from TX perspective, obviously you will get question related to UK tax, UK profits only. So you just have to worry about that element only. Okay. Now, third thing, third most important thing, because the tax rate applies on the taxable total profits, you must know how to calculate TTP, taxable trading profit. Okay. Taxable trading profit starts from tax adjusted trading profit. The adjustments are already in the uh, income from self employment, right? But remember one thing, that the only thing to bifurcate over here is, which I've also explained for in the steps ahead, that a company is an artificial person. All right, it's not an individual like a sole trader or a partner. It's an artificial person, right? So you have to make sure that you bifurcate this when you're talking about certain expenses that are allowed or disallowed, or for example, certain incomes that are taxable or not. Okay. You add, when you've adjusted the trading profit for tax purposes, that is why we call it tax adjusted trading profit. You
We have
add.
to
Mhm.
list
Yeah.
the trading, so it would be given in the question.
Yes, the accounting profit will be given in the question. You
Okay.
might have to make some adjustments, tax related adjustments to the accounting profit to get the tax adjusted trading profit.
Okay.
Okay. Right now, I haven't told you, with regards to both individuals and companies, I haven't told you the implications of having a tax adjusted, a tax allowable, not adjusted, tax allowable trading loss. All right. I haven't told you the implications for it, which is the last topic for this session. All right. It will be the last topic for this session so that you guys don't forget it, because there are certain rules that apply that you have to be very much aware of when you're in an exam question, when you're actually attempting a question like a question on losses. All right. So that's why I keep it for the end. Okay. So tax adjusted trading profit. If it's a tax allowable trading loss, we'll look at it towards the end. Okay. Tax adjusted trading profit, you'll add interest income to it, whatever the company has earned in terms of interest. This is not interest. Obviously, we're assuming over here that the company is not a bank. Okay. Your trade, your business is not to earn interest. That's why it's separate from the trading profit. Okay. Property income, let's say you've let out any property, a company has let out any property, you add its income. Miscellaneous income, right? We look at miscellaneous income as well. Chargeable gains. Already miscellaneous income, one of the examples, it's not usually, you know, it's not part of TX. For example, you can get royalty income as well, right? Royalty income turns out to be miscellaneous income. For example, dividend income is not taxable, but let's say if it were taxable, then you would have added dividend income as well. But remember one thing, like I said, dividend income is not taxable in UK. Dividend income for a company, not an individual. Individual is 7.5, 32.5, 38.1. Okay, with the 2000 nil rate band. Okay, but dividend income for a company is not taxable. Okay, chargeable gains, total profit, you deduct qualifying charitable donation, if any, and you get your taxable total profits. Remember one thing, if your total profit is less than a qualifying charitable donation, you will your loss cannot be created. Okay, you cannot have a taxable loss or tax allowable loss, right? Your total loss if over here, or total profit if eliminated by the qualifying charitable donation, will create zero max, not beyond that. Yes, if you have a tax allowable loss over here in case of total profit, then obviously the QCD gets wasted. Okay. Now there's some planning related to QCD as well. We look at it. Okay. Corporation tax will be calculated at 19%. Tax rates for the previous year, 18 and 17, were also 19%. Back in 2016, it was 20%. Before that, 21. Before that, 22, 23. It's been 24. Uh, I've seen 24 because I've been teaching for a very long time now. Okay. So 24, and now it's stable 19. For the past 3 years, it's been 19. Okay. Company pays tax of financial year, which I told you already, which starts from 1st April 2019, ends at 31st March 2020, rather than fiscal year, because fiscal year is the year for which an individual pays tax, which starts from 6th April to 5th April. Okay. Any DTR, it's not relevant for you. Double taxation relief is not relevant for you. Trading, interest, and property income shall include incomes from overseas sources as well. You will not get that in your exam. Okay. All incomes shall be included in the pro forma as gross. You will always get the gross income. You don't have to gross it up for anything. QCD includes all donations made to a charity. Okay. Do you understand this? So far, so good. I believe it's easy, not that difficult,
Yeah.
right?
Hmm.
Now, I've mentioned over here, when does a chargeable accounting period, which is a cap, starts, and when does it end. I want you to read it and try to make sense. If you have any questions related to it, obviously I'll answer it.
Nothing.
Right? It's easy to understand.
Yeah.
When does a cap start? When does the cap end? And when do you have to notify if you have become, or if you have basically entered the cap period, right? The first cap period. Cap is your chargeable accounting period. All right. Now,
Hmm.
dividends, if received from a UK company or overseas company, does not matter. It's exempt. All right. Dividends are only added to the taxable total profit to determine whether you're a large company or not. That's all. And what is the implication of being a large company? It is only on the methodology and the method of paying tax. That's it. Nothing more than that. It does not change your tax liability, does not change anything except for opens another door for you, a bit relaxed door for you to pay tax in a certain method, which we'll discuss in administration. Okay. Do you get it?
Okay.
You
Yeah.
add TTP, you basically add dividends to the taxable total profits, right? And you get augmented profits. If augmented profits are of 1.5 million or greater, you are a large company. All right. And I've mentioned over here as well, AP affects the way tax is paid. That's it, nothing else. All right. Now, following is the method through which each income shall be calculated. I've mentioned the way through each income will be calculated. Interest income is also called non-trading loan relation because it has no relation with whatsoever with the trade you're in, with the business you're in, because interest income is other than what, let's say you've invested in bonds, you've invested in, you've put your money in the bank, right? It's non-trading loan relation. Okay. Similarly, interest expense, if taken out for purpose other than trade, non-trading loan relation. Okay. So all income and expense related to borrowing and lending of money are called non-trading loan relation. It is very important to differentiate between both the trading loan relation and non-trading loan relation, as the latter is shown as a separate line item in the income tax statement. Separate line item means it's disclosed separately. All right. I've mentioned the differences between both trading and non-trading loan relation over here. I want you to read it, try to make sense of this area. This is basically I've taken snapshots from the book because it's self-explanatory. It's not that difficult to understand, right? So
Yeah.
trade purpose is anything that relates to trade, and non-trade is all the things other than a loan that relates to trade. Okay, so it's easy to identify a trading loan relation rather than a non-trade loan relation, because if you identify trading loan relation, anything other than trade is non-trade. All right.
Yeah.
Now, any interest that is classified as a trade loan relation shall be deducted from trading profits. Okay, because you cannot have an interest income with respect to the trade, because that is the job of a bank, that is the business of a bank, and you will not get that question in the exam. Okay. Any
Okay.
non-trading loan relation shall be shown as a separate line item. I already told you that. Non-trading loan relation shall be assessed for tax on accruals basis, just like any other income for companies. If you remember, in property income for individual, you had option to tax it on cash basis up till 150,000 pounds per annum of rent, right? But in the case of companies, it's always accruals. Okay. Non-trading loan relation, if included in trading profit, shall be deducted from trading profit, is shown as a separate line and shown as a separate line item, right? Loss is not examinable for you; it's examinable for ATX students. Trading profit. I just want you to read this part because it's already been discussed in, you know, in individuals, right? And similarly, property income as well, because I've basically deduced points that are easy to understand, easy to read. The only tricky part in corporation is group taxation and losses. Each and every point should make sense.
Yeah.
Is it the case or not?
Yeah, it is. It's
Well,
easy.
are you sure? Do you understand the private use of assets for capital allowances? In case of capital allowances, there could be no private use because it's the company we're talking about over here.
Yeah.
Do you understand that part as well? Property
Yeah.
income, right? Companies do not have a rental room relief or FHL. Okay. QCDs. QCDs, yes, they're charitable donations, but they do not in any way work like a gift aid donation for an individual. Okay. The transaction is the same, but if a company is making a charitable donation, it does not work like gifted donation. You don't get any HMRC relief, you don't get any HMRC contributions, you don't get any band extensions whatsoever, because you don't have any bands in case of companies, and there's no ANI whatsoever. There's no reduction in ANI and stuff like that, right? The only thing that you have to understand over here is that QCDs, if exceed the total profits, are wasted. All right. But yes, there's a possibility that the excess QCD can be relieved as per the group structure within your group companies, within your sister concerns. All right. But that is a topic for another day. Okay. Do you
Okay.
understand this?
Yeah.
Now, chargeable gains. This is a bit tricky over here. This is something different. In individuals, you used to have annual exemption allowance, right? Annual exemption amount. What was that? What was that amount? Do you remember? The
No.
AEA.
12,000.
Yes, 12,000, right? You
Yeah.
used to deduct this from chargeable gains, for example,
Yeah.
15,000, and then you used to get your taxable gains on which you used to pay your tax based on the type of asset. If it's residential property, it's 1828. If it's anything other than residential property, it's 10 and 20. 10 or 18 depends on whether you're a basic rate taxpayer. 20 and 28 depends on whether you're anything above the basic rate taxpayer. Okay. The capital gains for companies is a bit different. You don't get any exemptions. All right. But you do get adjustment for inflation. You do get an adjustment for inflation. All right. The logic behind this is, for example, I bought a property. All right. I bought a land. All right. For, let's say, now this is a company that's buying a land. Okay. For 100,000. Kept it for 10 years. After 10 years, the company decides to dispose it off for, let's say, 250,000. All right. This makes perfect sense. Up till here makes perfect sense, right? Because DP minus cost turns out to be your chargeable gain. In this case, it's also called unindexed gain. And you get an indexation allowance over here in case of companies. Indexation allowance. This allowance is an adjustment for inflation that actually reduces your gain to remove the inflationary effect. So that the only effect that is taxed is the gain in value of the asset, change in market value of the asset, other than the inflationary gain or inflationary increase in value. Do you understand? Because anyone who understands basic economics would know that this increase for over a period of 10 years is not because of is not only because of the market perception of this land, is not only because of the developments around the land, is not only because of the you know the additional value to be gained from the land. It's also because of the inflationary pressures during these 10 years in the in the economy, right? Does it make sense? Everything, or price of every other thing is pushed by inflation. It is affected by inflation. Even the bread or eggs that we eat, not that much, but yes, because obviously, even though it's dairy or it's poultry, right? But the point is that the prices do get affected. You know, a dozen of eggs 10 years back and a dozen of eggs in today's time. There's a huge difference. Why? Because the general concept is that money loses value over the period of time. Money loses its value over the period of time. Okay? So that is why the inflationary effect affects basically, is incorporated in this value change. So what we have to do is obviously inflation is something that is part of the economy. All right? It's something that everyone is facing. So it's not my fault as a company, that first of all, inflation is not my thing to tame. It's the government's thing. It's their job to tame the inflation. It's their job to monitor the inflation. It's their job to make sure that we're not in a hyperinflation phase, or we're not facing, extreme inflations or even deflations. We're towards a regulated growth. Okay, we're facing a regulated growth, a nominal growth, in terms of general increase in prices. Okay, so the point is that a government will not tax you on this, on just because there was an increase in general prices, a general price increase which led to an increase in the value of land, so you get taxed on it. It's not my fault, and it's not that I've gained from it. Right now, if I buy a land in today's world, the same type of land that was back then, back 10 years back, right, with the same characteristics, with the same vicinity, with the same surrounding, with the same resources, I will get it for, let's say, somewhere around 200 or 180 or 150. As a matter of fact, let's take it 150. All right, so the actual change in value is what? 250 minus 150. That should be taxed, not 250 minus 100. Because this increase of 50 from 100 to 150 is because of the general increase in prices, which is called inflation. Do you understand this logic?
Yeah.
And now let me give you a logic on the annual exemption amount as well. In case of individuals, this is the logic behind annual exempt amount. It's basically an adjustment, a fixed adjustment for inflation. Okay? Obviously, at that time, it wouldn't have made sense. So that's why I keep it for corporation tax. Okay? Do you understand?
Yeah.
Now, because if you know, for example, personal allowance works in a different way as compared to an exempt amount. Personal allowance gets withdrawn after a certain stage. That is, if your ANI crosses 100,000 pounds, correct? It gets withdrawn. But have I ever told you that the annual exempt amount gets withdrawn? No, right? I haven't told you anything like that, right? The point is, annual exempt amount is not anything like personal allowance. It is derived from the concept of inflation. Because capital gain is what? You keep an asset to wait for its value to increase and then you sell it. What we have, and what the government understands as well, is that this increase in value could not entirely be because of the change in market value of this asset or because of it generating additional resources. It could be because of inflation as well. And the part of inflation, the gain because of the inflation, cannot be taxed. Does not make any sense if you tax me for it. Do you understand?
Yeah.
So that's why in companies, for individuals it's fixed 12,000. In companies you get an indexation allowance which reduces your gain. Now the way to get Now this cost over here is again unindexed cost, all right? So there are two ways of reducing or to actually figuring out what the gain would be excluding inflation. So that you have two ways. Number one, you index the cost. One way is to index the cost. Or the second way is index the cost means you increase the cost by the amount of inflation so that you get a lower gain. Or you deduct an indexation allowance from the chargeable gain to get a lower taxable gain. And that taxable gain is taken to the corporation tax pro forma. Do you understand?
Yeah, kind of.
It's still kind of. What is it that you don't understand? I haven't talked about the formulas right now. I haven't talked about how to incorporate the inflation. The only concept that I've talked about is why this indexation allowance exists. That is the only thing I've talked about. Do you understand that or not?
Yeah, that I do.
That is clear?
Hmm.
Because I want you to be clear on the inflation part. Calculation, obviously, I'll tell you, calculation is something that you can easily memorize, right? Through
Okay.
practice, through formulas and stuff like this. Now, how to calculate the indexation allowance? Number one, this indexation allowance is an adjustment for the company for any gain in value due to general inflation. I already told you that. This is where you have the formula, which I told you on the right side as well. It is applicable, very important, very important. It is applicable on the assets purchased prior to December 2017. All right. It is applicable on the assets purchased prior to December 2017. If an asset was purchased after December 2017, let's say March 2018, April 2018, no indexation allowance is available. Okay. This date is very important. You get tested on it.
Okay.
Indexation allowance will be calculated in the following manner. So you have cost into indexation factor. That is how you calculate the indexation allowance. How do you calculate the indexation factor is over here. Indexation factor is a change in inflation and is as follows. RPI is retail price index, and this is what you will get in the exam. You don't have to calculate RPI. Retail price index at disposal date obviously will be higher. Retail price index at disposal date would be higher because retail price index is what? It's a basket. It's prices of a basket of things at a certain point in time, right? So at the disposal date, if there's inflation, it will obviously be higher, right? Minus RPI at acquisition date divided by RPI at acquisition date. So it's the same as new minus old divided by old, the way you calculate a percentage increase. Do you understand?
Yeah.
You get this indexation factor as a percentage, you multiply it by the cost, and you deduct it from the chargeable gains to get the, because this becomes an indexation allowance, right? You deduct it from the chargeable gains to get the taxable gains. Do you get it?
Yeah.
You sure?
Yeah.
Obviously, you will further understand this when we look at some exam kit questions. The IA is calculated separately from each item of expenditure. Remember this, and this is very important. For example, I bought this asset, I bought this land 10 years back. So, for example, right now, today is 15th November 2020, right? I purchased this back in 15th on 15th November 2010. Okay. Now, let's say on 15th November 2015, I made an improvement. Is it before December 2017? Yes.
Yes.
The expenditure that I'm doing is before 2017. So this is eligible for indexation allowance. Number one. Number two, it's an improvement. That means it's a capital expenditure. It will be capitalized, right? So the indexation factor, that means the RPI at disposal date, yes, will be the same for both of these expenses, the purchase cost of land and the improvement cost of land. The RPI at disposal date will be the same. Why? Because the disposal is on the same date. RPI at disposal date will be the same, but RPI at acquisition date will be different. Why? Because this, the RPI at 2010 would be different from what the RPI was in 2015. Do you understand?
Yeah.
So for each element of cost, so for example, 250,000 is the DP, cost is 100,000. Improvement cost, so this is purchase cost, this is improvement cost, is let's say 40,000. What chargeable gain am I getting?
110.
Yes, 110,000. All right. Now, indexation allowance of the purchase cost, indexation allowance of the improvement cost. How do I calculate indexation allowance? Let's assume that the RPI at disposal date, and you will get this in the exam, it will either be called RPI at disposal date or they'll just put down a date. Okay. And they'll say RPI at this date, for example, was, let's say, 250, right? RPI at 15th, I'm assuming the same example, at 15th November 2010 was, let's say, 194. RPI at 15th November 2015 was, let's say, 231. Okay. So you will get figures like these because RPIs are, complex figures to calculate. Now the point is, how do I calculate the indexation allowance? First, I need to calculate what? Indexation factor, right?
Yeah.
So indexation factor for purchase cost would be what? 250, because that's at the disposal date, minus 194 divided by 194. Correct?
Yeah.
And the indexation factor for improvement cost would be what? 231, sorry, 250 minus 231 divided by 231. Correct? What are
Yeah.
the answers for these? Can you calculate it for me?
First one is 0.2887.
This one is, sorry,
0.2887.
0.28. All right. So let's take it in two decimal places, 0.28. All right.
Second one is 0.0883.
0.08. 0.08. Okay, two decimal places. Now, how do I calculate the indexation allowance? So the purchase cost was 100,000. So the purchase cost was 100,000 multiplied by 0.28, the indexation factor. Similarly, 40,000 improvement cost multiplied by 0.08, the indexation factor for this. So this turns out to be 28,000, and this turns out to be what, 3,200 or 320? 3,200, I guess.
Yeah, 3,200.
All right. So what's the difference? What am I getting as taxable gain?
24,800.
Sorry?
Oh, you mean the total of it?
Yeah, total. 110 minus 28 minus 3200.
78,800.
78,800 is the taxable gain. Do you understand this?
Yeah.
You understand how I calculated the, again, you don't have to worry about this part
Okay.
because this will be given to you in the exam. All you have to worry about is the formula of indexation factor and how to calculate the indexation allowance from indexation factor. There's a possibility that in the exam you might get indexation factor itself. You don't have to calculate the indexation factor. All you have to do is multiply with the cost to get the indexation allowance.
Can this come for like a, can this come in section C?
Sorry?
Can this sort of a question come in section C?
It can come in any section. It can come in any section.
Okay.
All right. But yes, there's a higher probability for this question to come in section B and C. B or C, I would say. If it's in one paper, then it would be B or C. Okay.
Okay.
Now, the indexation allowance cannot create or increase a capital loss. Very important. Just like an annual exempt amount. An annual exempt amount used to get wasted, right? It could, it did not have the authority or the financial element of it to calculate to increase or create a loss. Similarly, the same thing goes with the indexation allowance. All right. Rollover relief is given to the company after deducting the indexation allowance, because again rollover relief should depend on the intrinsic value of the asset. All right. And plus, if you look at the logic behind rollover relief, you get it on a new purchase of asset. New purchase of asset has an RPI of zero. Zero means not RPI of zero, but inflation rate of zero. Why? Because it's a purchase of today. So today would be the base year for this particular asset, for this new purchase. You understand? So you have to make, or you have to eliminate the inflation element of the previous asset that you've disposed of to fund the new asset. Do you understand?
Yeah.
You sure?
Yeah.
Now, the matching order rules for companies in terms of shares and securities is a bit different. I want you to read it and try to understand if it makes sense.
In 30 days thing, right?
Yes, matching order rules for individuals of what? Same day purchase, following 30-day purchase, and share pool, right?
Yeah.
Over here, the only difference is the second one.
The 9 days.
Yes, previous 9 days purchase on FIFO basis, first in, first out. All right. But remember, there's another crucial difference. You didn't have to index the cost for shares at that time. You just had number of shares, value of shares, and total cost,
Hmm.
right? This time you'll be taking the indexed cost. Okay. Indexed cost is what? Cost into indexation factor.
Okay.
Okay. No rollover relief on the disposal of shares. Remember this in terms of companies. Okay. So release for companies include only rollover and holdover reliefs are available, because entrepreneur relief is not available because that is for an individual. Investors relief is not available because a company should not be involved. Technically, from tax perspective, that's not a business, right? Investing is not a business. Okay. It's a business, but it's not a trade or manufacturing business. All right. Does not attract reliefs. None of the other reliefs studied previously are available in case of companies, although following differences need to be considered. Number one, goodwill is not a qualifying asset for companies, which it was in the case of rollover for individuals. All right. Indexed gain is deferred, that is the gain after indexation allowance that we just studied, right? In rollover. Claim to reliefs must be made within 4 years of the later of the end of accounting period in which the asset is sold or replaced. All right. So that's again a date to remember, a period to remember, because you might get that in your MCQs. Okay, MCQs are section B OTQ questions. All right, do you understand this?
Yeah.
You sure?
Yes.
Each and everything, is it crystal clear or not?
Yeah, it's clear.
All right. Now, what I want you to do is before the next class, which is on Tuesday,
Yeah.
right? So, what I want you to do is before Tuesday, I'll try to send you VAT, right? But right now, since we've already started corporation, I want you to focus on corporation. We'll move on to the group taxation in the next class. What I want you to do is please make sure you have revised everything at least up till IHT. At least up till IHT. All right.
Okay.
I'm not saying that revision means you incorporate your practice and all of the stuff. Yes, you can keep the practice for the last 20 days, right? 20 days means that the remaining days which we have, right? But make sure that you're done with your revision at least up till IHT, because VAT and corporation are new topics. So this would be fresh in your mind if you've understood
Oh,
everything in the class. All right. So this would be fresh in your mind. You don't have to work very hard on corporation and VAT, but yes, you'll have to work hard on CGT, IHT, especially because these are the key areas. These are the most favorite areas of the examiner. Okay,
oh,
you understand?
yeah.
So now I'll see you on Tuesday.